Lentra and CNBC TV-18 Digital Lending Summit, Mumbai, India.
With that, we prepare for another enriching fireside chat as we have the privilege of hosting two very distinguished leaders who have played a very important role in shaping the landscape of retail assets and financial services. Our esteemed speakers will delve into the topic of profitable scaling in retail assets, sharing insights and experiences that promise to be both enlightening and inspiring. And to moderate this session, may I please welcome CNBC TV-18's Ritu Singh. Also put your hands together for Arvind Vohra, Group Head, Retail Assets, HDFC Bank, and Rakesh Singh, MD and CEO, Aditya, Birla Finance.
Thank you, Mugdha, for that introduction. And welcome, Mr. Kapil Vohra, Mr. Rakesh Singh. Thanks very much for being here. And, you know, we're talking about profitability in building or scaling retail assets. And who better than some of the country's top lenders from the banking space and from the NBFC space to really spill the secrets on how you're doing it. So welcome again. Thanks very much for your time. Mr. Vohra, I'll start with you on the profitability aspect of it. You know, in the second quarter, banks have posted, I see you're looking worried already, but, you know, it's been a stellar second quarter for the banks when it comes to profitability, with HDFC Bank also almost 33% growth over the previous year on an industry-wide level. As you look at the year ahead, just tell us what are the various factors in the current macroeconomic and regulatory environment that are going to shape the trajectory of how banks like you grow?
Well, I think the aspect of growth in India is really about looking at the size of the prize. India is in its sweet spot right now. From an HDFC Bank point of view, we are very large, and some of us do talk about that. But on the other side, there's still 80-85% of the country that we have to explore into. And that's where we are looking at expanding our reach from a physical infrastructure point of view. We are looking at expanding our access through digital lending. And really the fundamental anchors being insight-driven innovation, a very, very disciplined risk management approach, rock-solid corporate governance, and just be focused on doing the right work for customers.
And Mr. Singh, do you share that optimism? As an NBFC, you had a 40% sort of a growth in the last financial year. What will this year look like?
So if you look at, first of all, look at the Indian economy. I think Indian economy is doing very well. It's the fastest growing large economy in the world. The GST collection, if you see, that clearly indicates the economic activity in the country. That's been doing and has been growing quite robustly. So the economic activity and the GDP growth, if you look at in the country, really provides opportunity for players like us, with the banks and the NBFCs, to really do business. But we are in the lending business. We do business with, and we are also in the business of risk management. So every loan which we give today, I think we give it for 3 years, 5 years. So I think one needs to be very risk collaborative. It has to be calibrated with the risk in terms of how do we manage our risk, because to sustain in this business, we need that aspect as well. Risk management is the key to our business. So we see big opportunity in the next 3 to 5 years, and not only in this financial year, but in the next 3 to 5 years, huge opportunity for a player like us to grow business across different customer segments, whether it's the MSME. MSME is a big driver for the Indian economy. We are focused on the MSME. If you look at 50% of our loan book is to the MSMEs. And that's the segment what we think will grow even more. If the economy has to go from a 4 trillion to 5 trillion and 7 trillion, I think this piece of the economy will grow quite fast. So very, very enthused and encouraged looking at the opportunity, but we have to do the business within the guardrails and in a risk-calibrated manner that we can sustain this growth and the business over a period of time.
I mean, since you brought up the guardrails and growing in a risk-calibrated manner, do you think the retail piece is growing a bit too fast?
No, so it depends on if you're talking about the industry. There are some pockets which has grown slightly faster than the overall industry credit growth. So unsecured loans below 50,000 rupees loans, which RBI has flagged off as a segment which has grown really fast. And anything which grows really fast and exponentially. One needs to really be watchful for that and needs to really see that we are doing business in the right manner. And recent regulations or changes which has happened by RBI, I think that really tries to focus on that in terms of managing the risk. So yes, anything which grows too fast needs to be watched carefully, and that's what RBI is doing.
Well, we'll get back to that piece, but first, Mr. Vohra, if you could give us a sense of how retail lending itself is changing. Banks are not overtly only reliant on, expanding the branch network to get to that last mile customer. As you're adopting technology with the evolution of systems like the account aggregator framework, the GST data giving you a lot of insights, the UPI expanding payments to a new to credit customer segment that never transacted before. How is technology enabling your bottom line when you look at retail segment as a piece today?
See, we believe the transformation is happening at two levels. One is, as we were discussing in the previous discussions also, banks see themselves more as technology companies. The fintechs are there, and I think this differentiation is going to get more and more blurred. So this transformation happening in traditional organizations, they are becoming technology-centric. Two, I think the whole digital public infrastructure, whether we call it account aggregator framework, e-sign, UPI, credit on UPI, all of this enablement starting from JAM in 2014, which has driven bank account as basic as that, penetration from 40% to 78, 79%. And some of these things have become the cornerstone for these two transformation to intersect and really be able to expand to different parts of the country. What retail, in the retail segment, digital lending does is, one is very, very clearly access. The access becomes ubiquitous, right? India is a large country. There are going to be limits to the physical infrastructure reach. So every segment of the customer can be reached through digitally. And if in the far beyond areas of Jharkhand that we were talking about, Instagram can be one of the popular apps, that why can't digital lending be as popular as that? However, that has to happen with the right risk management, underwriting on the fly, right algorithms, right kind of surrogates for different segments, urban, rural, semi-urban, different customer segments, profiles, and so on and so forth. And while all of these, the new DPI elements, be it account aggregator, all of these are huge, huge enablers. But some of the things like SLAs, how the account aggregator framework works and so on and so forth, those will need to be also resolved as we sort of try to get the full impact out of that. So interesting sweet spot, a lot more to be done, but I think next 2 to 3 years, as long as we pursue these two transformations parallelly, both happening in the ecosystem as well as in our own respective place, I think that's where the magic is going to lie.
Well, a sweet spot it is, but just for our audience to get a sense of how digital is changing the nature of the game, any statistics you could share with us that, for instance, could tell us how many of the new retail loans that you're originating are done digitally now versus physically, and how that looked, say, 5 years ago?
See, again, this is a layered question. I mean, at some level, we can answer that question, and it's there in a lot of investor reports. For some categories, it could be as high as 90-95%.
What categories would those be?
For example, personal loans, for example, it's almost 99%, which is digitally originated, right? But we have to unpeel the onion and look at various layers of it. How many are digitally originated? How many are assisted digital? Which segments of customers need assisted digital? And then how many of them are unassisted digital, right? A large part of the segments would work fine absolutely with unassisted digital. And even assisted digital we see as a precursor for people becoming more confident with the journeys and UI, UX, and getting as comfortable as they are probably on Facebook, Instagram, to be able to do it on their own. So this is an evolution, but I think the journey is really towards unassisted digital more and more. And not just in personal loan categories, but I think in all the different categories, look at digital adoption in a very, very significant way.
But just to simplify it, I know you said it's a layered question, and there are various categories within retail that may be more digitally adept than some of the others. But if you're generating 10 loans, let's say today, how many of those would be done digitally only?
So as I said, in personal loan, almost 100% are originated digitally. Okay. In business loan, the number could be different. We could share those numbers. But the good and important thing is all these numbers are rising, right? I mean, the unassisted digital number is rising, and the assisted digital numbers are also rising, which means that customer segments are becoming more and more comfortable with it, point one. And the second part is we have to look at the drivers of what will keep this scale going up, you know, how we are designing the UX part, right? If you have to look at rural India, do we have vernacular, right? And what can really unleash rural from a digital retail lending point of view? The underwriting approach for semi-urban and rural. Maybe there is different surrogates, different way of underwriting for the new to credit and semi-urban and rural will need to probably evolve. Some aspects around credit on UPI, etc. also may help in that journey. So I think a lot of innovation around, one is digital, two is data analytics, and three is building the entire technology backbone to really support these two. And unless all of these three happen together, you know, the results, the right results will still be, you know, away. So that's what we are working on.
Well, you know, Mr. Rakesh Singh, as an NBFC, typically your business model is to go into the areas that banks would not. You know, you'd be going to perhaps what he may consider riskier segments. I just want to understand, with the use of technology, with the use of more data that is available today, how has it broadened the pool even more for you, you know, within the risk guardrails that you put for yourself?
So it's not that black and white that wherever banks do, we don't do it. I think we haven't
very
drawn.
gray.
Yeah, we haven't drawn a line in terms of. I think we do business what really fits into our risk appetite. We have a certain cost of borrowing, and on that basis, we really define what is our risk appetite. And clearly, yes, there will be customers who will go to bank preferably because from a liability side, they will be banking with them and all. But our reach in terms of the way we reach to different customer segments and customize the product offering. So I think that's point number one. But to really talk about digital and all, I think retail and consumer credit is getting transformed in India. Yeah. So if you look at today, you have a KYC. Earlier when we used to do KYC, you have to go collect documents and you have a proof and everything. Today, Aadhaar, OTP, video KYC, you can do the entire KYC completely. Then you have the bank statements. You can analyze the bank statements completely online. You have an account aggregator, as you mentioned. So clearly the entire enablers are present today. Today, once you have built the capability of delivering to the customer a complete online digital journey, you can deliver a 15,000-20,000 rupees loans also to the consumer. Earlier, if we had to deliver a 15,000-20,000 rupees loan, the cost of delivering that would have been as much. Because you are reaching out, first of all, to the customer, you are collecting documents, you are analyzing, you are assessing, then you are underwriting the loan. So today, we are in a position that a small ticket loan can be delivered to a customer in a very simple process and at a very minimal cost.
Okay.
So what FMCG companies did with sachet products, I think today we can do for sachet loans. So clearly that piece in terms of reaching out to many more customers and consumers in the country, I think this digital journey, which is powered by your KYC, your banking analysis, your entire digital UPI, you have the digital and the payment transactional history which is available and you can underwrite customers. So credit bureau has become so strong in the last 20 odd years in the country. So consumer credit and small ticket loans are getting transformed.
So you're telling us you're using technology to get to customers you would not have been able to get to before. You're telling us how even small ticket loans, considered not the most profitable pool, the cost is coming down thanks to technology and so on and so forth. But what are the challenges that come along with you know, extending digital credit? I mean, we hear enough and more about it from the regulator. You know, whether it is slowing down the unsecured piece, whether it is the digital lending guidelines, whether it is the risk sharing with the FLDG and so on. But what would you highlight as the key challenges that you see when you're looking to expand this digital lending pool?
So I mentioned earlier also, we are in the business of lending.
Yeah.
We give money today, we collect after 3 years, 4 years. So we are in a business of a risk management. Whether we do a large ticket transaction or a small ticket transaction, the entire due diligence of the customer has to be done thoroughly. You cannot, it's not that you distribute loan because as we say inside our company that we celebrate when we collect the loan, when we don't celebrate when we give the loan. So clearly it's about the collection as well. It's just not, the job does not end when we give the loan. So building robust and strong underwriting models, understanding the customer behaviors, understanding the customer's cash flows, understanding the customers, I think these are important things which through data, through these digital infrastructure which I spoke about, has made it quite possible to reach out and underwrite. In terms of challenges and all, there can be some frauds, yeah, which is because you are not face-to-face. I'm not coming and doing a personal interview and saying you are good for a loan. So there can be frauds. How do we mitigate that risk? There are certain in terms of leverage. Again, when you, so credit bureau information will come with a lag. Once a lender has given a loan, you don't know how many more loans the borrower has taken. So what is the kind of leverage which has built up at a customer level, at a consumer level, and their ability to service that debt? I think these are the risks and the challenges which we will have to really work on in terms of we need to watch out leverage. That leverage should not at a consumer level, at a customer level, doesn't go that they find it difficult to serve the loan. Mitigating the frauds, online frauds. I think these are the issues and challenges which we need to really mitigate.
Okay, Mr. Vohra, would you like to add on to that? So of course, with digital, we've seen rising instances of frauds and steps have to be taken to correct that. But, you know, at the end of the day, the weakest link is what sets off the whole chain. One there, and secondly, also on the aspect again, the second challenge that he outlined with frauds. What to your mind have been some of the biggest challenges? And, you know, if you could give us your sense as a bank, what you faced.
See, at an industry level, the biggest imperative in this business is to have a disciplined risk management approach. Very, very disciplined underwriting. While some of the elements, FMCG like sachets, etc. can be done, but this is very unlike FMCG kind of a business. You know, unless underwriting is rock solid, ending up with you know, poor quality of book is going to just take the cycle back. So from that point of view, for example, our unsecured book, which the published numbers on our NCLs, the credit losses, etc., is significantly superior to the credit losses of the secured book of the industry. You know, so I think we believe in a disciplined risk management approach to go along with the, you know, digital lending, enabling the opening of the size of the opportunity, and also this risk management approach has to be an integral part of this digital lending itself, because without that it will be incomplete, and then it will make us prone to a lot of other risks coming and you know, facing the industry.
Or the over-leveraged risk as well.
See, that doesn't even work for customer. I mean, if a customer, for example, if there is a fintech player or there is a player X, ABC, not looking at the fixed obligations, and that person is taking 20,000 rupees from 3 players and just over-leveraging, that's not going to even work for that consumer, because a negative credit record is going to put him out for a home loan or an auto loan years down the line when his life is moving on. So it's very important to integrate disciplined risk management into the whole digital lending piece.
Well, you know, you've spoken about some of the challenges when it comes to digital lending, but you know, what is the size of the opportunity I want to understand? And, you know, we often say India lives in its villages, and that's a fair statement given 2/3 of a population is there. And you brought up sachetization as, you know, which is often touted as one of these big solutions, you know, to cater to that last mile customer. Perhaps if the size of the loan is smaller, if it's profitable for you to do so, that would solve that piece of the rural puzzle. To your mind, when you look at retail lending in the rural regions, in the unbanked regions, you know, what are emerging as some of the big solutions thanks to the advent of technology?
So the two big challenges that the digital lending can help us solve for rural. The first is the, you know, access. Geographically remote areas, villages, and even semi-urban towns, right? Very difficult to put the physical infrastructure in each and every town of the country. So that's where the digital lending piece comes in. The second equally important part is that, you know, when we look at the formal credit in semi-urban rural, especially the lower echelons of the semi-urban and the entire rural segment, Still, there's a large part of the, borrowers, the adult borrowers that are there, a significant proportion are still out of the formal credit system, right? And I think that is waiting to be explored in terms of, what is the right way to sort of get into those segments, bring them into formal economy. And it should be possible now. I mean, the way the whole Jan Dhan Aadhaar mobile penetration has done it, 650 million smartphones in the country, almost 100% mobile penetration, 80% banking account penetration. So it's feasible to do. But I think we'll have to innovate in our credit approaches, credit algorithm, differentiated leverage of surrogates for semi-urban and rural, solve the challenge of access through digital lending, use vernacular, lose other medium, the short video formats, other formats that the people are a little bit more comfortable with. And so I think those are the variables that will have to be, played around to be able to penetrate that segment. But the opportunity is, of course, very, very large.
Okay. I just quickly want to move back to the unsecured piece. Because, you brought that up earlier about how the Reserve Bank of India may be a little worried about how one particular segment is growing much faster than the industry. Now, when you look at this retail piece, I want to understand, while it's reversion to mean, so to speak, in terms of the increase in risk weights now, in the short term, do you see some disruption in the growth of the retail piece? Because banks, on one hand, have to set aside higher capital, NBFCs have to set aside higher capital, and your cost of borrowing from him will also go up.
No, so if you see, we do business across different customer segments. So we do business in the consumer segment, retail, which is MSME, mid-corporate, large corporate. So we have a very diversified business. Retail and a consumer segment and an unsecured segment is a small part of our overall business. But in terms of risk weight going up, will it impact in terms of the cost of borrowing, first of all, and the risk weight on the capital side? The answer is yes, though very minimal. And if there is an increase in cost of fund, we will have to pass it on to the customers. I think because if the cost of doing business goes up, it will get passed on to the customer. So clearly, we are looking at in terms of, and to your question, what will be the impact of this? I'm sure there will be some moderation in terms of the growth in this segment, because I think the way the regulators have seen that the growth in this segment has really gone up significantly post-COVID. And there must be some reason of cause of concern there. So you will see some moderation in the growth in this segment. The way I see it in the coming quarters, you will see some moderation.
Since our time is up, final comments from you. Do you think that is going to slow down the retail piece in the very near term? And if not, what will be the biggest drivers of retail growth in the near future for banks like you?
No, not for us. I think we have said it before. We have enough capital, and we'll continue to make sure that we continue to accelerate, along with making sure a very, very disciplined risk management. But that to us is more integral to our making sure that the vision that our MD has given of doubling over next every 4.5 years, that we build it in a very, very sustainable manner, and that can only happen when risk management is integral part of the whole business. And I think as part of the digital lending, we are excited about all of these three areas. One is digital lending, which is about creating digital properties, journeys, the right UI UX, frictionless. Two, embed data analytics, the predictive data analytics, and that is both from point of view of underwriting and also from point of view of propensity, right? We do a lot of analytics around. We talk about a lot of analytics around underwriting. But I think propensity is as equally critical, so that we are able to understand, and personalize proposition for different customer segments. And three is the whole technology transformation in terms of APIfication, in terms of technology backbone, cloud native strategy, and so on and so forth. And I think these three pieces have to really go hand in hand. And that's what we are really working on. We are very excited with that. And that's really the backbone of what we are saying in terms of the growth outlook over next 4 years. So I may not be able to make you happy on why you started by saying that I look worried, but I may not be able to tell you my growth outlook for next quarter, which is what you may be trying to get out. But over next 4 years, our ambition is to be able to really, double our book over every 4 years.
Yes, a new HDFC Bank every 5 years. Yeah. Yes, Mr. Singh.
Yeah, so I just wanted to add that, yes, moderation will be there in this segment, the unsecured segment.
Only in the unsecured piece.
But the other segments, your SME, your secured businesses, I think that will continue to grow. And given the way the economy is doing and is growing so well, the GST collections are so robust, we see a big opportunity and growth opportunity in the coming years.
So up and up from here on that very optimistic note, Mr. Singh, Mr. Vohra, thank you very much for sharing your thoughts with our audience. It was a pleasure speaking with you. Thank you.
Thank you.
Thank you so much.
Pleasure.
Thank you.
Lentra and CNBC TV-18 Digital Lending Summit, Mumbai, India.